Here's something that should make you angry. The average Australian works for around 45 years. They wake up early, commute, sit in meetings, deal with difficult bosses, come home exhausted, and do it all again the next day. And after 45 years of that, the median Australian retires with around $200,000 in superannuation. $200,000, that sounds like a lot, until you realize it runs out in about 7 years if you spend just $28,000 a year. So they spend their whole life working to fund maybe 7 years of freedom, and then what? That is not a retirement, that is running out of time and money at the same time. And this is not an accident. Stay with me because in the next 13 minutes I'm going to show you exactly why this happens, and more importantly, the exact steps to make sure it doesn't happen to you. But first, a quick note. This video is for educational purposes only and is not financial advice. I'm not your financial advisor. Always do your own research before making any money decisions. Now, why does this keep happening to almost everyone? It's not because people are stupid. It's not because they don't work hard enough. It is because the financial system was never designed to make ordinary people wealthy. Think about it. Who taught you about money? Was it school? They taught you algebra, but not compound interest. They taught you about Shakespeare, but not about shares. Was it your bank? Banks in Australia make billions of dollars a year. The Big Four alone pocketed over $30 billion in profits last year. They are not incentivized to make you rich. They are incentivized to make themselves rich. And was it your employer? Your employer's job is to pay you as little as possible while getting as much work out of you as they can. That is not cynical, that is just how business works. So you were set up to spend, borrow, and work. Not to invest, build, and grow. The system rewards spending. Credit cards, buy now, pay later, 30-year mortgages, 0% finance. It is all designed to keep money flowing away from you. But here's the thing, the wealthy understand a completely different set of rules. And those rules are not secret, they're just never taught until now. So let's get into it. There are 5 reasons why 90% of people never retire rich, and 5 things you can do right now to break that pattern. Reason number 1. Almost everyone earns money the same way. They trade their time for it. You work an hour, you get paid for an hour. You stop working, the money stops. Economists call this linear income. You are the machine. If the machine breaks down, you get sick, lose your job, want to take 6 months off, the income stops immediately. Wealthy people still earn a salary sometimes, but they also build what are called assets. Things that make money while they sleep. An asset could be a share portfolio that pays dividends. It could be a rental property, it could be a business. The key idea is, the asset works, not you. The fix for reason 1, start thinking about how to build even one income stream that doesn't require your direct time. Even $50 a month in passive income is a starting point. Reason number 2. And this one genuinely blows people's minds when they see the numbers. Most people have never actually sat down and calculated what compound interest does over time. Here's the simple version. Compound interest means you earn interest on your interest. Your money grows on top of itself, like a snowball rolling down a hill. Let's use a real Australian example. Imagine you invest $10,000 in an ASX index fund, one that tracks the whole Australian share market, and it returns an average of 8% a year. That's roughly what the ASX 200 has averaged historically over long periods. After 10 years, that $10,000 becomes around $21,600. After 20 years, $46,600. After 30 years, over $100,000. You didn't add a single extra dollar, the money just compounded. Now imagine you invest $500 a month on top of that. After 30 years at 8%, you would have over $740,000. Nearly $750,000. And you only put in $180,000 of your own money. The rest, over $500,000, was created by compounding. But here's the critical thing, and this is what the banks don't want you thinking about. time is the ingredient. The longer you wait, the more you lose. Starting at 25 versus starting at 35 makes an absolutely enormous difference. The fix for reason 2, start investing as early as possible, even if it's a small amount. Time in the market beats timing the market every single time. Reason number 3, this one is sneaky, and almost everyone falls into this trap. It's called lifestyle inflation. Here's how it works. You get a pay rise. Maybe your salary goes from $70,000 to $85,000 a year. Congratulations, that's $15,000 extra. But within 6 months, you've upgraded your car, moved into a nicer apartment, eating out more, new subscriptions, and somehow you feel just as broke as before. Your expenses expanded to fill your income, and then some. This is why people earning $150,000 a year can still live paycheck to paycheck, because their spending grew just as fast as their earning. The wealthy do something different. When they get a pay rise, they pay themselves first. They immediately redirect a portion, 20%, 30%, even 50%, into investments before they ever see it in their spending account. In Australia, you can automate this, set up a separate investment account. The moment your pay hits, an automatic transfer fires and moves money straight to your brokerage or savings account. You never see it, you never miss it. The fix for reason 3, every time you get a pay rise, increase your investment contribution by at least half of that raise before you spend any of it. Reason number 4. Superannuation. Now Australians are actually pretty lucky here. We have a forced savings system that most countries don't. Your employer puts in 11.5% of your salary right now, and that number is going up. But most people make 2 massive mistakes with super. Mistake 1, they completely ignore it until they're 50. Mistake 2, they trust that it will be enough. Super is a great foundation, but it probably will not be enough on its own, especially if you want to retire before 65 or if you want to retire comfortably, not just survive. Here's what smart Australians do. First, they actually log into their super fund and check their investment option. Most people are in the default balanced fund. That's fine, but if you're under 40, a high-growth option invested heavily in shares has historically delivered better returns over the long run. Second, they consider making voluntary contributions, even an extra $50 or $100 a month into super, especially using salary sacrifice, which uses your pre-tax dollars, can make a dramatic difference over 20 or 30 years. Third, check your fees. Super funds charge management fees, and if yours is charging 1.5% or more, that is silently eating a significant chunk of your retirement. Compare it on the government's Money Smart website. The fix for reason 4, log into your super today, check your investment option, check your fees, and consider starting salary sacrifice, even a small amount. And reason number 5, probably the biggest separator between those who retire rich and those who don't. Most people never invest outside of their superannuation. Remember, you can't touch your super until you're 60, in most cases, so if you want any financial flexibility before then, the ability to retire at 45, take a year off, start a business, you need to be building wealth outside of super as well. The most accessible way to do this in Australia is through index funds or ETFs, exchange-traded funds. These are baskets of shares that track an entire market, like the ASX 200 or the global market. You can buy them through a brokerage like CommSec, Perler, or Stake. Many have no minimum investment, and unlike picking individual stocks, which is incredibly hard to do consistently, an index fund just tracks the whole market. If the Australian economy grows, and it has, over every 20-year period in modern history, your index fund grows with it. You're essentially betting on Australia not going to zero. That's a bet most people are comfortable making. The fix for reason 5, open a brokerage account. Even if you start with $500, look at low-cost ETFs that track broad markets. The 2 most commonly discussed in Australia are VAS, which tracks the ASX 300, and VGS, which tracks global developed markets. You don't need to be an expert, you just need to start. Alright, let's bring this all together, because I want you to walk away from this video with a crystal clear picture of what's been happening and exactly what to do about it. The system was never designed to make you wealthy. School didn't teach you this, your bank doesn't want you to know this, and your employer just needs your labor. But the 5 reasons people never retire rich are all fixable, right now, at any income level. Let me recap them fast. Number 1, stop only trading time for money. Start building even one asset that generates passive income, even something tiny to begin with. Number 2, let compound interest do the heavy lifting. Start investing early, even if it's $100 a month. Time is your most valuable financial asset, and you are burning it every day you wait. Number 3, fight lifestyle inflation every time you get a pay rise. Automate your investments so the money is gone before you can spend it. Number 4, actually engage with your super. Log in today, check your investment option, review your fees, and think about salary sacrifice. Number 5, start building wealth outside of super. Open a brokerage account, look at broad market ETFs. Start simple, start now. Here are 3 things you can do before you go to sleep tonight. Action 1, go to moneysmart.gov.au. It's a free government website, and use their compound interest calculator. Put in your age, how much you can invest per month, and see what your money becomes over 20 or 30 years. That number will motivate you. Action 2, log into your super fund tonight. If you don't know which one you're in, check your payslip or the ATO's MyGov portal. Check your investment option and whether you're on a high growth setting if you're under 40. Action 3, research a brokerage account. Some popular ones in Australia include CommSec, Perler, or Stake. You don't need to buy anything yet, just open the account and understand how it works. Momentum matters. Link in description for all 3 platforms. Wealth is not about luck. It is not about your salary. It is not about being born into the right family. It is about understanding the rules and then using them. The 10% who do retire rich aren't smarter than you. They just started earlier, stayed consistent, and never let the system spend their money for them. If this video helped you see money differently, do me a favor, hit subscribe, because every week I break down exactly how money, investing, and the Australian financial system really works, so you can stop being surprised by it and start using it.